And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show. I'm your host, Lance Roberts. Danny Ratliff will be joining me here in just a little bit as well to talk a little bit about markets, what's going on. A lot of stuff happened yesterday, of course. Big news, of course, yesterday. Well, inflation came in hotter than expected, right? So we saw a bit of an increase in inflation. It was kind of expected widely by most of the Wall Street analysts, economists, et cetera, that we might see weaker rates of inflation, actually a negative print of 0.1 or 0.2% on the inflation run on a month-over-month basis. That wasn't the case. We saw a positive print in CPI. Now, overall, CPI actually declined on a year-over-year basis, but again, that hotter print than expected really stirred the markets yesterday because it pulled off this whole narrative. Over the last 4 days, we've talked about this rally in the markets. It's been a fairly strong one. And, coming off that support line, that this kind of rising trend line that we've had in the markets. And, that was all based on this premise that the Fed would hike rates by 75 basis points at the end of the month, which is actually next week. And that might kind of be the it for a lot of these more aggressive rate hikes. And if we started seeing kind of weaker inflation prints, we've seen a decline in energy prices, that would help, alleviate some of this pressure potentially from the Fed. That wasn't the case. Now, energy prices did decline. Unfortunately, it's a much smaller component of the CPI calculation. Food prices, housing, and shelter, those are bigger components of the index. Those rose. And again, there's a lag, as we've talked about before, there's a lag effect to housing prices. It takes time between the time that rates go up and housing slows and the time houses get sold or, prices get dropped. And when interest rates are rising, houses start to stay on the markets longer. So the transaction takes longer to complete. So we don't have the data for that sell for a bit of time, but by the time it shows up into the housing data, it takes several months. It takes about 3 months, and that's why there's about a 3-month lag to a lot of the housing price data. And it's just because of that process of getting the house listed, sold, closed, etc., and getting that final data. So again, we're still seeing the rent of shelters go up. We're still seeing, housing prices still high, even though they are starting to come down, but not enough to bring down the overall rate of inflation. So even though we saw commodity prices decline, it was offset by rising food prices at the grocery store. And again, a lot of consumers still paying for that. As a consequence of that, of course, this rally in the markets we had over the last 4 days got unwound very quickly because, again, it was all based on this premise that we'd see weaker rate of inflation and the Fed would start to back off potentially on rate hikes. Yesterday's CPI print certainly did not sway the idea that the Fed would reduce their expectations or start to slow their advance. In fact, the percentage chance of a full 1% hike in the Fed funds rate next week is now at about 35%. So a 75 basis point rate hike is pretty much baked into the cake. That's going to happen next week. But there's now a rising chance the Fed could even be more aggressive, going up by 1%. And then that led to the sell-off yesterday. Yesterday's sell-off was the biggest one-day decline since June of 2020 in the S&P. So we got to go all the way back to post-pandemic to see a day where the market was down 4% in a single day. It was a very big decline. Now, that's the bad news, right? Big sell-off yesterday. That's the bad news. The more positive news, I guess, if you want to try to throw that out there, because this morning on CNBC, it's just markets in turmoil everywhere, red banners, right, all across the board. We're still in this positive kind of rising trend line from the lows that we set just a couple of months ago. So that bullish kind of trend line is still holding in place. Now, again, this is this kind of contrary setup we've got going in the markets. We're still in this kind of consolidating pennant pattern in the markets. We got this rising set of bottoms. We still have a declining set of peaks in the markets, but that is getting much more narrow. That trading range for the markets becoming much more narrow. So a decision is coming, right, for the markets. Now, that decision is either going to be a break to the downside, which is going to happen by the end of the week. If we're going to break to the downside, I would suspect to see that by end of week, right? And we will break to the bottom of this trend line, and that will suggest that we will come back and retest these lows that we put in back in July. If we're able to hold this rising trend line and stay within this range, now markets are kind of pointing a little higher this morning, so we have a little bit of green this morning across the indexes. We'll see if that holds. Again, that sell-off yesterday surprised a lot of investors. It didn't really give you much of an opportunity to do anything yesterday because that sell-off was so sharp. There's a lot of trapped investors in that market right now. So again, any rally this morning probably is going to get sold into a bit. We'll see. But if the markets do break this rising trend line, that's going to certainly set us up for a retest of these lows that we put in back in July. Now, yesterday we were talking about also our MACD indicator, which is kind of that really good buying indicator for the markets, very close to triggering a buy signal. Yesterday, that was reversed, of course, and that indicator has not triggered because of yesterday's sell-off. Again, very close to setting a trigger, but now it's going to take a little bit more work before that to happen. So again, that really good indicator has continued to kind of, keep allocations a little bit more cautious, raise, a little bit higher cash level because we're still in a sell mode right now for the markets, and that kind of continued to play out yesterday. Again, now one thing about yesterday's sell-off too, from a more, I guess, as I said, a more bullish perspective, if you want to look at it that way, is that there was really no sign of a pickup in volatility. If you take a look at yesterday's market, you're down 4%, and when you're down 4%, you're certainly expecting that, people are certainly probably panicking at that point. But we didn't really see that across the board. In fact, volatility, it rose a little bit, but still very much confined into this very kind of complacent line of the markets. So again, despite all this kind of sell-off this year, the markets are down 20%. It was, the biggest one-day decline since June of 2020. Markets really not panicking much over it. Again, investors not really panicking. In fact, if you take a look at investor allocations, we're not seeing any negative outflows from equities right now. So despite the selling, right, we're not seeing a shift in investors across the board globally just taking money out of markets and getting more defensive. Now, that could certainly change, right? And again, as we kind of move forward from here, the Fed is hiking rates, as we've talked about before. The risk ultimately is that they go too far, they break something in the markets, and create some type of credit-related event. Now, that would probably spark an outflow of equities from the markets, and that's going to lead to that broader decline potentially in markets if that occurs. But there's kind of no guarantee of that either. So as we continue to kind of watch markets, it pays to pay attention to what's happening. And right now, there's not a lot of panic in the markets. In fact, there hasn't really been any panic this year at all. Despite the market selling off, markets are still trading well within the 20 handle of the VIX index. I mean, we haven't spiked up to levels of 30 or 40 or 50, which is, areas we've seen previously during big bear markets. And so again, this market kind of remains very complacent relative to the overall environment. We'll see how this plays out, but again, just continue to remain cautious here, be a little bit patient, hold a little bit of extra cash, and we'll kind of navigate from that. When we come back from the break, we've got a lot more to get into this morning about yesterday's sell-off, where to go to next. That's coming up on The Real Investment Show with Danny Ratliff. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back to school time, and for your high school student, it's time to fill out the infamous FAFSA form for college financial aid. Mistakes could cost you money. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Liebem Thursday, September 15th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome. Can you back up a little bit? Get all up in my face. There we go. My dermatologist called me yesterday and said, hey, I need to check that spot on your face there. Jeez. Mr. DeMille, it's time for your close-up. Anyway. Good morning. Welcome back to the show. I'm your host, Lance Roberts. Danny Ratliff joining me this morning. Hey, Danny, how are you?
Hey, good morning. Doing great. How about you, Lance?
Awesome. So interesting. So I have an interesting question for you. And I think, and because, we hear this a lot from customers, and this is going to get into a little bit of the psychology here in a second. But there's an interesting thing that's going on right now. So yesterday, the kind of the trap door opened in the market yesterday. Nobody's really expecting that sell-off. A lot of it was positioning. This Friday, we've got a $3 trillion options expiration event on Friday. So a lot of yesterday's sell-off was advanced positioning for that setup on Friday. So there was a lot of potential there. We've got record puts on stocks right now by hedge funds. You had record long call options as well. I mean, you had a lot of potential break points in the markets, and all showed up yesterday. But that inflation print, that was the trigger for that sell-off. And again, it really didn't give you a lot of opportunity to do anything yesterday. I mean, markets just kind of opened up at the floor and stayed there most of the morning and then sold off some more in the afternoon. But here's an interesting byline of all this. The 2-year Treasury, which front runs the Fed. So if you ever want to know where the Fed funds rate is going to, all you have to do is watch the 2-year Treasury because it's pricing in where the Fed's going to. And that 2-year Treasury is now pushing 4%. Now, here's the interesting point about this. If that is the case and the Fed does go to 4%, which has been the Fed's kind of commentary as of late, that means that you could very well see a money market fund coming back to 4% yields. So here's the question. And here's my question to Mr. Ratliff this morning because he hears this a lot. I hear this too. We have customers come in all the time and says, look, if I could just get 3% on my money, I'm good. That's all I need. Give me 3%. Annual on my money and I can make ends meet and I'm fine. I don't need to take any more risk than that. Well, now you can get that at 4% in a money market account. So if you could get a 4% money market account, would you still invest in the stock market? right? Why take the risk? If all you need is 3%, as we're often told, why would you take the risk at 4%? Now, of course, the obvious answer to this is yeah, but what if the market starts going up again and I can make more than 4%? See, this is always the psychology of it, right? This is where the greed factor kicks in. You just told me all you need was 3, and now I can get you 4 in a money market, or there's actually some other alternatives we'll talk about this morning.
Well, but it's a huge conundrum that people are experiencing right now, because that's right. A lot of people say, listen, I can get 3-4%, I'll be happy. Well, that was prior to inflation at 8.7.
Right.
Big difference. Or 8.3. And I think that these are things that we need to continuously monitor and watch for. And look, people also say the other side of the coin here is that, well, listen, I'm not keeping up with inflation, so there's no sense in investing here. Mm-hmm. Now, yeah, if that's a long-term investment and inflation stays this high. I had a call last night, Lance, and from somebody you know well, and said, Danny, what are we doing with the plan? Our plan, we're not having inflation. We've adjusted for inflation, higher inflation over the last couple of years, saying, look, we think it's going to remain higher for a bit longer, but we don't have it at 8%.
Right.
But is 8% that sticky?
No.
Is 8% going to stay there? So that would be a big difference. If we're going to assume for the next 20, 30 years of your life, this is where inflation is, yeah, that's a problem. But if it's also, you're right, because many people are saying, okay, well, listen, I want 3 or 4. Now we're getting closer to 2, probably between 1.5% and 2% on money markets. And if those rates continue to rise, that could be a great place to store funds for a bit if the market remains volatile. But like you mentioned, it's tough to say, okay, we're going to stick everything here. Now, I like this option for short-term positioning, right? Because, look, you can avoid some volatility. If you increase your buffer. We've talked about having your emergency funds plus a financial vulnerability cushion. And not to mention, just within our regular portfolio management, we will go to cash and overweight at different times because we want that ability to go in and buy lower. And if we can get paid a little bit more for it, great. But I think this is a big problem that many people are trying to wrestle with.
Right. Well, and again, how sticky is the 4% money market going to be? I mean,
Well,
as soon as the Fed goes back to dropping rates again because they've broken something, and see, this is the problem. And again, this is where investors are going to make mistakes. Is they're going to go, I'm just going to get out of the stock market because I can get 4% on my money market, and then as soon as something breaks in the market, they're going to feel really smart for about 20 minutes, and then the money market rate's going to go right back to 0 because the Fed's going to drop rates in order to bail out the economy and the markets, and then you're going to be forced to come back into equity. So, this is going to be the challenge. And to Danny's point, inflation's not going to remain at 8.3, 8.6, 8.7. Inflation, and this was the interesting thing yesterday, despite the fact we had a hotter inflation print on a month-over-month basis, inflation actually slowed. And it's actually slowing pretty sharply. And we're likely going to see that continue to move forward. So we're going to get from, now it's not going to go from 8% to 2 in a month, right? But, by the end of the year, we could well be into a 7 handle on inflation and, still be having the Fed hike rates, because where's the Fed want to get to? They want to get back to that 2% inflation rate. But that also means slower economic growth, as Jerome Powell just said recently, so we're going to have some pain here to get us back to that level. But, look, but Danny, there are a lot of people that need this kind of, they need kind of a guaranteed income, right? Almost and we talk to a lot of people, right? They have a pension at work and they're saying, okay, I'm getting ready to retire. And, for a long time they say, I have a pension. Should I take the lump sum option or should I take the pension? And for a long time, it's really been, you should keep the pension because you can't match that payout, in the market on, with valuations at 20, 30 times earnings. You can't match a 4, 5, 6% payout on your pension with long-term returns on markets, but that may now be changing as well.
It's interesting. So, we look at these and we do a lot of evaluations within our financial plans. Should you take the lump sum? Should you take the pension? And depending on the scenario, and I will say this, most people do take the lump sum. And in fact, if you go to most advisors, they're going to tell you to. But what we want to do, we're going to look at, we're going to get down in the weeds on this and say, okay, here's what this means for you. Here's what this looks like long-term. This plan looks better if you take the actual pension payment versus if you take the lump sum, or, many times it's the opposite as well. So we want to evaluate that, understand what that internal rate of return is. And historically, what most people ask is, hey, can I take these funds out, go buy an annuity or something else, create my own pension on a secondary market? And the answer was no for many years because we could not duplicate that type of internal rate of return. That is beginning to change with these higher interest rates. Now, keep in mind, if you have a pension out there and you're about to retire, you think you're going to take the lump sum. When rates increase, your lump sum decreases. Now, it's quite the opposite. So it's a seesaw. So when rates increase, your pension payments are going to increase as well. But if rates decline, lump sums go up, pension payouts go down because they would rather incentivize you to take the lump sum, get it off their books. So what we're actually beginning to see is that for the first time in many, many years, you could actually go out and buy something on the secondary market that's better than what your actual pension payout would be. And that hasn't happened, Lance, in, decades. It's kind of remarkable to see it. And so, many people are struggling with, okay, what do I do? I know people who are retiring early, and I'm talking about several years early because they're so afraid of where rates may go and what that change is and what their actual lump sum is. So they're saying, hey, I'm going to go ahead and take this out and I'm going to go contract work, or I'm going to do something a little different. Maybe switch firms, go ahead and get the ability to take possession of these funds. So this is something that I think if you're struggling with, make sure you talk to your financial planner. Give us a call, realinvestmentadvice.com. We'd love to help you and kind of help you understand what this means for you because this is a big deal and there's a lot of money left on the table here.
Yeah, there is. And that actually goes to Social Security as well.
Yeah.
One thing that we've talked about, numerous times is, Social Security already has a funding problem because of just demographics and the fact that since 1965, we just keep putting more and more people on the rolls that don't contribute, right? So, we've added in all kinds of people that don't pay into Social Security that they can still get Social Security. And so now we have this kind of this inverted pyramid where back in the 30s and 40s, we had 16 workers paying into the Social Security system. Now we only have, basically 2 workers paying into the system for every worker taking out. And one of the big problems from inflation is going to exacerbate the funding problem of Social Security because this year, every year you get a COLA adjustment, it's a cost of living adjustment for Social Security, and it's based on a calculation of the inflation rate. And it's never the same, right? So, if you have 8% inflation, you're not getting an 8% bump in your COLA, right? You might get 2 or 3. But this year, we could see an actual bump to Social Security payouts of up to 8.7%. And the problem with that is that the long-term kind of predictions of solvency for Social Security is based on a much lower rate of COLA adjustment. And, a lot of people ask, when you go back and look at CPI, we used to calculate CPI very differently prior to the Clinton administration. It was based on a basket of goods, and you measured that basket of goods on a year-over-year basis. There wasn't all this finagling and mathematics to it. It was a pretty basic calculation for inflation. In the late 90s, Bill Clinton was trying to balance the budget, and so he did a couple of things. He changed how we calculated unemployment and immediately removed 500,000 people from the unemployment rolls, made unemployment look better. And then he changed with the Boston Commission how we calculated CPI to lower the rate of CPI in order to lower out the inflation payment, those COLA adjustments to Social Security, which made Social Security look more solvent at the time. That's now played catch up with us here 20 years later, as the real cost of living for Social Security recipients is far different than what they actually receive in the COLA adjustment. We'll talk about this a little bit more when we come back from the break with Danny Ratliff. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back to school time, and for your high school student, it's time to fill out the infamous FAFSA form for college financial aid. Mistakes could cost you money. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Liebum Thursday, September 15th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Elon Musk recently took a large shareholder position in Twitter. He made some comments that Twitter should be the town square where everybody can freely have their opinions heard without censorship, etc.
The Real Investment Show podcast. Same show, your schedule.
The staff at Twitter are apparently so triggered, they were even stressed on their monthly day off for a day of rest.
At realinvestmentadvice.com.
It's called the weekend, folks.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
It's back to school time for your high school student. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Liebum Thursday, September 15th at noon at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me. So just for the break, talking a little bit about Social Security. And Social Security faces a challenge this year in particular, and Danny's talked about this before on Financial Fitness Fridays as well. Talk about Social Security is that, you know, we continue to see the Social Security Board of Trustees talk about the solvency of Social Security and how long we have until they potentially have to cut payouts. And this is all based on, you know, kind of mathematical, you know, calculations based on historical rates, right? So at 2% inflation, they look at their COLA adjustment, say if I have to make a 2% COLA adjustment every year, then my bucket of money is going to run out in 2025. Well, this year, Social Security recipients are looking at an 8.7% bump to their cost of living adjustment. Now, that means that more money gets paid out of Social Security and not more money is coming in. So this is going to potentially accelerate that insolvency point for Social Security at some point. And we'll see what the Social Security Board of Trustees say about this, you know, at the end of the year. But this will be a year where Social Security recipients get a nice little bump to their paycheck, and how long it lasts is going to be a different issue, of course, right?
Well, it is. And even last year, they received that bump of 5.9%. But then if you were on Medicare, you actually saw an increase of over 14% in your Part B premiums. And so this is one of those deals where these increases, they're nice, but they're not keeping up with the pace.
Right.
The other problem, Lance, is that if we look at CPI in general, we're using CPI-W, so we're using a workers index as far as how they calculate those cost of living adjustments, when really we should probably be using CPI-E, which is for the elderly. So sorry, guys, I know you're not elderly, but it is one of those things that we need to take, be cautious with when we understand how inflation works and what that looks like. We've been a big advocate over the years of switching that CPI-E, which has actually been legislation out because it more closely tracks what a senior citizen is spending, a lot more with healthcare expenses, prescription drugs, things that, everybody, if you're in that kind of demographic right now, you understand those things are not getting cheaper. And so it would be much better if we actually changed how we calculated it. If we get that 8.7% bump, that's great. And listen, every year we get when the Congressional Budget Office comes out and they do new surveys, and there's many, bipartisan tax foundations that come out and say, listen, Social Security is going to come out and we're going to have a problem. And so, for instance, for the last couple of years, at 2030 is going to be an issue. Then it was 2032, then 2033. It's currently 2035 before there's a reduction in benefits. And that reduction is a 20% reduction at the moment. So, yes, it's concerning. I do believe that we're going to have to fix this problem at some point. Unfortunately, they continue to just kick the can down the road. And while there's been many, each year there's a lot of legislation out that's actually looking to address this, I just can't get any. Well, it has no legs.
And the other problem with it too is that the reason it doesn't get any legs is because it's not politically electable, right? And so, me coming out, okay, so Danny, I'm going to run for president this year, and my platform is I'm going to reform Social Security. We're going to get it fixed to make sure that it's here, right? So everybody's going to have to take a 30% cut to their benefits, and if you're under 50, you're not going to get it.
Yeah,
you're still
but
going to pay in.
Require that,
right? If I'm just making an example, right? So, and you're under 50, you're not going to get Social Security at all, but you have to pay into it. Okay,
correct.
So that's nobody's going to vote for you, right? And this is why. But the problem is on the other side is that even President Biden just recently came out and has been trying to pass legislation to increase the payouts that we give to Social Security recipients. We want to give them more money, and the problem is as we go back to just basic math, you've got fewer people paying in to the system, and we keep taking more out of the bucket.
Well, that's right. It's not only just they want to pay people more, they're actually talking about doing paternity and maternity leave. Yep. This is opening up to a whole demographic that typically is not going to be even included in this unless you're on disability.
Right.
So yeah, we're finding ways to drain the coffers rather quickly. But there's going to be, I don't think the legislation has to be as harsh as what you just mentioned. I mean, right. I think we can do small things that are, a little bit more palatable in the sense that, okay, what if we say instead of 67, we begin to increase it? Just like if you're born between 55 and 60, every year you get an additional 2 months. You have to delay Social Security until you can actually take it, until it goes all the way to 67. You could do that to 68. You could have more income taxed. Currently it's just under $150,000 it's taxed, and then if you make more than that, you're getting a pay raise.
Right.
So you don't see that 6.2% coming out of your paycheck. So there's been legislation that'll tackle that as well and say, okay, I don't know how they come to the math on this, but we're going to give you basically a donut hole. Once you get above that amount, you're going to get a break until you make over $300,000 or $400,000. Both those numbers have been thrown out. Yep. I would assume that at some point that's just going to go away. There's going to be no income limitations, and that actually fixes it much quicker, Lance.
It does.
By including all these numbers. But the deal is, and I think the biggest concern is that Social Security is going to go away completely, and I don't think that's going to be the case because too many people rely on it. I mean, if you look at the numbers, more than half retirees rely on it for more than 50% of their income in retirement. There's actually a quarter of it rely on it for like 75 to 80%.
Yep. Look, the problem though, and you're right. No, it's not going to go away.
Yeah.
You're never going to take away a welfare program. Okay.
No.
And
which is the problem. We keep on coming out with more and more.
Well, and that's it. And see, the part of the, what your solutions are. Look, let's raise the people are living longer, right?
But
let's raise the retirement age to 70. But you can't keep adding more people to. It's like the student loan debt, right? You can't. Forgive debt and then put more people on the rolls.
Yeah.
You've got to, at some point, you've got to say, okay, if we're not going to add any more people to the rolls unless you're just retiring.
But hold on, too.
And
this
you
is
paid
not,
in, right?
I take a little bit of offense to it. I'm sure many out there.
Yeah.
It's not a welfare program. It's not intended to be.
It is a
but
welfare
you're
program.
paying into it. You have put money into this program. For some, yes, who've never worked, who've never done, you've never been in the workforce. Yes, there's that entitlement aspect to it.
Yeah.
But you are entitled to these funds because you have put funds into it.
Right. But you're putting funds in for the other people.
Yeah.
Right. So you're not putting this is the mistake that people make. People think that, it's an entitlement program because I'm paying into my account.
No.
You're not. You're paying.
It's a pyramid.
Exactly. You're paying it for other people. So it is a welfare program. So if you're offended by that term, sorry, it is. That's what it is, because you're paying for all these people that have not paid into the system.
Yeah.
Correct.
Yeah.
And so you've changed it from an entitlement program, which you were correct, it used to be, into a welfare program. And that's okay. I mean, there's nothing wrong. Look, there's nothing wrong with welfare. We all get offended by that term. It's like, oh my gosh, I'm getting something for the government.
Look, there's people that actually need it. I'm
exactly.
okay with it.
No, look, to Rich's point, right? If you stop Social Security today, there's dead people laying on the streets, right? Because
you think we have a homeless problem now?
Exactly.
Yeah,
no,
worse.
you can't do that. But it's a $96 trillion unfunded liability, and so somebody's got to pay for it.
Yeah.
And it's a big problem long term. And this is the problem for the Fed, right? The cost of service on the debt. So think about this. Every tax dollar that we collect every year, more than 100 cents of every dollar of tax revenue being collected goes to pay Social Security, prescription drug benefits, Medicare, Medicaid, and interest on the debt. And interest on the debt is rising sharply because we have $30 trillion in debt and the Fed's hiking interest rates. So when you see interest rates growing up, that debt service requirement is more tax revenue coming out. So outside of Social Security, Medicare, prescription drug benefits, and interest on the debt, everything else is paid for by debt. So education, energy department, national defense, all that's all coming out of more debt, which means an additional payment that's got to be made. And this is why, everybody's trying to go after the rich people to get more taxes because, we got to try to figure a way to pay for some of this stuff.
This is why we're such strong advocates of understanding where you're putting funds now, because you're going to pay for it later. So you think, okay, great, I'm going to get this big tax break. Well, look, that may be fantastic for this year, but what's that going to look like in the future if tax rates continue to increase? Which, how do you not? We continue to give money away. Mm-hmm. I would have to assume that rates are going to go up. And if you think you're going to be, don't worry, I'm going to fall into a lower income tax bracket, that's not always the case.
No. Well, and again, look, we don't make policy, so.
No. But we do have to be very
aware of it.
Aware of it because, look, these are things that we have to deal with and help clients navigate day in and day out. And so that's why, I think you could probably tell we're a little bit animated about these things.
Well, it's because, you have a whole generation of people coming up right now that want free stuff, right? I want free college. This is the interesting thing about the student loan debt. You have just now set college tuition to spiral out of control because once you forgive student loans of $10,000 or $20,000, my son just got a $20,000 Pell Grant. He's applying to get it paid for, right? He literally just got it, right? But here's the problem. Now colleges go, wait a second. Students can go out and borrow money and then you're going to forgive the debt because they only have to pay 5% of their disposable income. And then after 10 years, the debt's written off entirely. That's what this new process looks like if it actually comes to reality. Then why not, as a college, why do I not just keep jacking up rates? Because now people can borrow more and more money, pay 5% of their disposable income, and then get it forgiven after 10 years. You have just now removed any cap potentially to student loan debt. And if people can figure out they can get free money from the government, why not? Right? And so this whole idea of hiking more taxes and creating more taxable revenue and all this, this is going to become a much bigger requirement, to your point, Danny, is that in the next 20 years, we could be talking about not just an income tax, but starting the Europe model of having a value-added tax on top of that.
Well, this is a big wealth transfer.
Yep.
I mean, it really is. I mean, everybody's concerned about means testing on Social Security. Guess what? We already have that. Talking about how much is taxable. If you make between $35,000 and $44,000, you have 50% of your Social Security taxable. If you make more than $44,000, 85% of it's taxable. Listen, same thing with Medicare. The more money you make, the more you pay. I think it's just going to continue.
Oh, yeah. So, financial planning, very important. Be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back to school time, and for your high school student, it's time to fill out the infamous FAFSA form for college financial aid. Mistakes could cost you money. Our next virtual Lunch and Learn will help you maximize your free application for financial student aid, the FAFSA. Register now for this free Lunch and Learn with Danny Ratliff and Chris Liebum Thursday, September 15th at noon at realinvestmentadvice.com. Filling out the FAFSA is vital for getting financial aid. Learn how. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning, 647. Futures are flatlining this morning right now after yesterday's big sell-off. We'll kind of see what happens at the open this morning. Let me give you a date. March 29th, 2021. Now, why is this date important? This date's important because this was just after President Biden passed another round of stimulus checks and sent out $1,400 to households. Now, this was the third round under President Trump. He did $1,400 and then did $900 that December. And then in 2021, after the election, President Biden takes office and he immediately does another round of $1,400 stimulus checks. Okay. The president's stimulus bill at that point was quickly written up by a lot of media outlets talking about what it will do to the population or to the economy. And this was according to the Center on Budget and Policy Priorities. The current child tax credit and EITC together lift more children above the poverty line, 5.5 million, than any other economic support program. This level of poverty reduction was achieved through multiple expansions, and the recent addition will continue that process. What's interesting about that, and I wrote it, so if you go to our website, realinvestmentadvice.com, and in the search bar at the top, type in the word poverty, and you will get an article right at the top that says Biden stimulus will cut poverty by 40% for 1 year. And what's interesting about that is that has now become a fact. Because, again, at the time, if I give Danny money, right, so Danny's under the poverty line, and so I give Danny money that gets him above the poverty line. Well, if he's above the poverty line, what we don't talk about is what happens to the economy. Well, immediately, everybody else that's providing services to Danny raises their price because I know now Danny has more money, right? So child care costs go up, right? Housing costs go up, food costs go up, energy prices go up. Because everybody knows you've got more money to spend and there's a demand-supply imbalance, and that creates inflation, and that inflation puts people back under the poverty line. It's the tax on the free money, right? And it's interesting here because now we're talking about 8.9%, 8.7%, 8.3% inflation. If you look at inflation as a function of what Danny was talking about a moment ago, I run a measure of inflation that strips out the kind of, how we do inflation less, food and energy. If we take a look at inflation that's just really kind of focused on the cost that people, the elderly pay, right? Health, to Danny's point, healthcare cost and those type of things. That inflation rate's still over 9% right now. So they're paying almost a full percentage more in inflation than the average worker, right? And so that's what's happening, right? So if I only give Danny a 5% pay bump and inflation's running 9%, he's still in the hole. And so that's what happened. And so we wrote an article March 29th of 2021 saying this whole lift of people out of poverty will put them right back into poverty a year later, and it'll be worse. They'll be even more impoverished than they were before. And, this is actually we're seeing that now.
Well, it's very inflationary in nature. If you look at the child tax credit, for instance, that went up considerably, where it used to be just basically a tax where it wasn't a refundable credit. It became a refundable credit, but they also started paying that on a monthly basis. They increased it. They actually opened it up to include more people. So 36 million households on average received those checks. But not to mention the stimulus checks and everything else that occurred. But then they take all this away. They create this inflation. We had supply chain disruptions, and all these things are inflationary without that. So now you've exacerbated and really multiplied the problem. And that's where we get into this big issue. So you put people, while it may have been good for the moment, it's much worse now. Mm-hmm. And at that time, hey, don't worry about paying your mortgage, your student loans, anything else. So you created a problem.
Right. And that's, and it's interesting too, because back then everybody touted the bill as the second coming of FDR. FDR did have a lot of, the New Deal under Roosevelt did have a lot of social programs embedded into it, but it was also getting people back to work. And, the problem with a lot of these stimulus bills that we did is that there was no incentive to get people back to work, right? In other words, if you don't have to pay your mortgage, if you don't have to pay your student loan debt, if you don't have to pay your rent, and I'm giving you free money, what's your incentive to work, right? And so, that's been a problem. So we've created this supply-demand, like I said, the supply-demand imbalance. And now that free money has come due and has to be paid back, and you pay it back through higher inflation. And that's what's occurring. The problem now, though, is that we're creating a bigger group of people living below the poverty line now than we did before, right?
Yeah, I mean, we are seeing that. So as more and more people are beginning to fall below the poverty line, especially with inflation. Households with fixed income. So the demographic that's suffering the most, Lance, is actually those 65 and older, because they don't have the ways that the human capital they once had. I mean, not some do, but not all, where they can continue to work. And so if you're living on that fixed income, this is really problematic. And now, granted, listen, if they gave all these programs and it was continuously year after year after year, it'd be inflationary in of itself. But now you've created the inflation, but you've taken away what helped create it, which makes the problem even bigger.
Right. So a couple other things here. We're getting ready to wrap up the show this morning. Again, big market sell-off yesterday, biggest since June of 2020. Obviously, lots of people concerned about it. There was no panic in the market yesterday. It was simply a reversal of that run-up that we've had over the last 4 days. And I did wipe out 4 days worth of gains literally in one day. That doesn't feel well. And then, of course, when you turn on CNBC this morning, it's markets in turmoil on, every banner that's up.
Actually, literally.
Literally.
That just popped up. Wow.
So, that's been the case this whole morning. Futures were positive earlier. They've gone back into negative territory. So not surprising. See a bit of follow through selling this morning. What'll be important is whether or not we can hold that uptrend line that we kind of been establishing since the July lows. If we break that, we've got some, potential lower levels to go here. So we'll see what happens. Now the Fed's looking, the expectations are 100%, basically 100% probability the Fed will hike 75 basis points next week. And now there's a 35 basis point expectation. They could go a full 1% next week as well. So we'll see that. So again, just kind of we'll pay attention to what markets are doing today. But also this weekend, right? Is it this weekend?
No, tomorrow.
Tomorrow. We have a important lunch and learn for people needing to get ready for college.
Yeah, so Chris Liebman and I, we're doing a FAFSA webinar. It's going to be something you can go to realinvestmentadvice.com, go to our events tab. You can sign up right there. Really, we're going to talk about what are the things you should be doing. How do you prepare to start filling these forms out?
I think you need to explain what FAFSA is.
Yeah, so basically, this is the forms. Well, listen, if you have a child that's going to college,
is that like a
falafel? It's very similar to a falafel.
Do you put powdered sugar on it?
Yes.
Powdered sugar.
So this is the form for federal aid, and if you're looking for
there's no sugar
Pell
on
grants, loans, you're going to be filling these out. You're going to list the colleges you'd like to attend. There's many different dates. There's a lot of nuances with it. Chris has been there, done that. He helps a lot of our clients navigate this, and I think it's really important to make sure you don't leave any money on the table. This is a problem, Lance. If you look back in 2021, there was I can't remember the number exactly. I think it was $37 billion that was left on the table.
What is it that people miss the most? I mean,
you don't fill it out.
Well, yeah,
it's overwhelming. Number one, right? it is overwhelming, or you just don't fill it out correctly, and it's really easy to make mistakes on because you can include.
Is it like income issues, or
it could be income, it could be assets. A lot of people will put retirement accounts down when you shouldn't be doing that because that's not something you're going to utilize for college tuition. So these are things though that he also, what I really liked about it is Chris provides some tips that he did that I think that go a little bit above and beyond just filling out the forms that really helped him become successful. Like we were talking, I said, hey, man, how did you guys afford, like he had a daughter that went to UT, another one went to Boston College and then went on for a master's. And I said, how'd you afford all this? He said, man, there's so much money out there, but you got to work for it. He's like, it's a second job. And he went above and beyond in so many ways. And I think that if, a lot of people may say, hey, I know the basics here. And you probably know the things that you should do, but many people don't. He did it, and he got money from it. And so those are things I'd really like people to take away from it. But go to realinvestmentadvice.com, check on the events tab. You can sign up. It's going to be live there. We'll be answering questions in the background. And, just lots of information. And it's not that long. It's 20 to 30 minutes.
Yeah, and of course, if you need help after that, obviously, you can just click the Ask a Question button at the top of the page and ask a question to Chris, and I'll be happy to help you as well. But that event banner is right at the top of the homepage. So if you go to realinvestmentadvice.com, right at the top of the page, it says Avoiding Costly Mistakes on FAFSA. And that's tomorrow, 12 noon. There's a Register Now button. It's really super easy. Just fill that in, get registered, and we'll send you a link, and we'll see you tomorrow.
And Lance, the response from this has been incredible. I mean, this is something people struggle with.
Right.
And guidance counselors, I feel like, should be doing for you guys out there, I'm sure some of you do a really good job, but there's so many people that just feel like they're in the dark.
Right. Well, no, look, there's so many things that you've got to kind of navigate when you're trying to get student loan applications, stuff done like that. And it's just, and again, like you said, it can be a second job trying to get all this stuff.
Well, what's was eye-opening to me, I mean, I don't have children that are having to deal with this yet, but it's the dates. All these universities have different dates you have to have things in by. And so I don't think many people know that. So they may have the university of their choice, but they're not prepared for it, and then they get stuff in late, and you just miss out.
Yep, that happens. All right, that wraps up the show for today. Danny, thanks so much.
Thank you.
Get by the website and get registered for the FAFSA Lunch and Learn tomorrow. It's at noon, Thursday, September the 15th, with Chris Liebman and Danny Ratliff. And then, of course, while you're there at the website, there's a big button that says, how can we help? So just send us a question, comment, email, whatever we can do to provide you a better show, provide you more information, give you help. Always happy to do it. Always happy to hear from you. Also, while you're at the website, get our latest blog post, our newsletter. Make sure that we have all of our subscriptions right there on the front page. Subscribe to our newsletter, our daily market commentary, our YouTube channel. Be sure and collect the little red bell icon as well so you get alerted to all of our new videos that come out every single day, like 3 minutes of Markets and Money, which will be up here in just a few minutes. You'll get an alert for it. We'll keep you up to date. Also, Simplivisor. Check out our platform. Absolutely free for 30 days. That's also there. All at realinvestmentadvice.com. Have a great day. See you back here tomorrow.